Hey everyone, welcome back to Crypto A1, where we will be showing you the latest tips and tricks in the financial space as well as business and entrepreneurship. Bitcoin and crypto never sleep, and neither do we. It has been confirmed during a congressional hearing on Wednesday, March 2. Federal Reserve Chairman Jerome Powell confirmed that he sees rate hikes this month as appropriate, meaning on March 15th, during the Fed's meeting, this is happening. On March 15th, be ready. That's exactly what I want to talk about in today's video. Let's look at how the Federal Reserve rate has changed over time and what this means for you. Before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot. And subscribe with notifications on for more crypto-related videos like this one. Now, let's jump in. Powell still expects rate hikes to happen, but noted that the Russia-Ukraine war has added uncertainty to the outlook. According to Powell, there will be a series of increases of quarter percentages in the coming months, but he did not rule out more aggressive action if inflation persists. As part of remarks prepared for dual appearances before House and Senate committees this week, the central bank chief acknowledged the tremendous hardship being caused by the Russian invasion of Ukraine. The implications for the U.S. economy are highly uncertain, and we will be monitoring the situation closely, Powell said. It remains extremely uncertain what the invasion of Ukraine, the war, sanctions, and future events will do to the U.S. economy in the near term. When making monetary policies in such an environment, it is important to consider the fact that the economy is evolving in an unexpected way. We will need to be nimble in responding to incoming data and the evolving outlook, Powell added. He also said that the Feds want to control inflation, but the bottom line is that they will proceed cautiously as they gain greater insight into the effects of the Ukraine war on the economy. Inflation in the US is at its highest level in 40 years, compounded by a Ukraine war that has driven oil prices to around their highest levels in a decade. In January, consumer prices rose 7.5% from a year ago, and the Fed's preferred inflation gauge showed its strongest 12-month increase since 1983. Since the beginning of the year, Powell and his fellow policymakers have been hinting that they plan to raise benchmark interest rates to combat inflation. He reaffirmed the stance that the process would involve interest rate increases, alongside indications that the Fed would eventually start reducing its bond holdings. We will use our policy tools as appropriate to prevent higher inflation from becoming entrenched, while promoting a sustainable expansion and a strong labor market, he said. We have phased out our net asset purchases. With inflation well above 2% and a strong labor market, we expect it to be appropriate to raise the target range for the federal funds rate at our meeting later this month. Powell said rate hikes will likely be done in quarter percentage point increments, though he said he would be open to more aggressive moves if inflation worsens. When confronted with questions from members of the House Financial Services Committee, he replied, "We're going to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain moment. To the extent that inflation comes in higher or is more persistently high than that, we would be prepared to move more aggressively by raising the federal funds rate by more than 25 basis points at a meeting or meetings. It is still expected that inflation will fall." He said that as soon as rate hikes commence, the Fed will start cutting its asset holdings. The Fed has been buying treasuries and mortgage-backed securities at the fastest pace ever since the start of the COVID pandemic, pushing the total holdings of the central bank balance sheet to nearly $9 trillion. Powell pointed out that the reduction will be carried out in a predictable manner by rolling off some bond proceeds each month rather than reinvesting them. In terms of the economy, the chairman still expects inflation to slow later this year as supply chain issues are resolved. During his remarks, he called the labor market extremely tight and mentioned significant wage increases, especially for lower-income workers and minorities. "We understand that high inflation imposes significant hardship, especially on those least able to make the higher costs of essentials like food, housing, and transportation," he said. "We know that the best thing we can do to support a strong labor market is to promote a long expansion, and that is only possible in an environment of price stability." Data from CME Group show that markets have fully priced in an increase at the March 15 to 16 meeting, but have decreased expectations for the rest of the year since the Ukraine war broke out. As of now, Traders are pricing in 5/4 percentage point increases, taking the benchmark federal funds rate from its current range of 0%, 0.25% to 1.25%, 1.5%. Feel free to comment your thoughts on this down below. Nevertheless, I feel it's important to set the record straight since many people think that Federal Reserve is about to break the crypto market. They think that Jerome Powell's plan may result in a crash of Bitcoin. Let's take a step back and look at things from a different perspective. Here's a look at what has historically happened with Federal Reserve rate increases and decreases. When we see multiple rate increases in succession over time, we eventually experience a recession. They increase until there is a recession, then they reset. The most recent time of such a chain reaction occurred in 2005. Rates were raised year after year after year until the 2008 housing crisis, when we entered a recession. Once that happened, the rates immediately reset again. We still have a long way to go before a lot of this happens. First of all, a great deal of the current price of Bitcoin is already baked in. This rate hike was already announced months ago. Well, historically, they haven't always done that, and now the market is prepared ahead of time. We experienced the correction. We're not saying the market can't dip lower. It certainly can. But for this first rate increase, it has already been incorporated into the price. The second reason is because the very last time we saw consecutive rate hikes was at the very end of 2016. And 3 times in 2017. How did Bitcoin fare during the end of 2016 and 2017 for those of you who were in the crypto market that time? Over the course of this time, Bitcoin went from about $1,000 all the way up to $20,000. Taking a look at the full price chart of Bitcoin, we actually had several rate hikes before we actually had 3 rate hikes in 2017 as the crypto market continued to grow. Over time, they hiked it up so much that it totally needed to be corrected. Everything had to go back down, and that's what ended up happening. However, that did not occur with the first rate hike. As always, we'll watch what exactly the Fed ends up doing on the 15th, because what they say and what they do could be completely different. So stay tuned. That's it for today. If you're still here, I bet you enjoyed the video. Give it a thumbs up and don't forget to subscribe if you haven't already. We'll be regularly posting finance videos that will help you grow abundantly. So stay tuned. We'll see you in the next one.